Today, the FOMC decided to leave our policy interest rate unchanged. Today, the FOMC decided to leave our policy interest rate unchanged. Today, the FOMC decided to leave our policy interest rate unchanged. Today, the FOMC decided to leave our policy interest rate unchanged. Today, the FOMC decided to leave our policy interest rate unchanged. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a quarter percentage point. Today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a quarter percentage point. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong, and that is very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today, On this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions. Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5% and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions. Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June, Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
No change. The Federal Reserve holding rate steady in the range of 5.25% to 5.5%, but stressing that officials see progress towards their inflation goal, hinting that they are drawing nearer to a rate cut. The committee changed language in the statement to say that in recent months there has been, quote, some further progress toward the committee's 2% inflation goal. That's a change from, quote, modest further progress in the prior statement. They also noted risks to both sides of the dual mandate, inflation and full employment, quote, continue to move into better balance versus moved toward better balance in the prior statement, meaning that now the Fed sees the risks to both the employment and inflation sides of its mandate more equally weighted, whereas before they saw more risk to the inflation side. They say, quote, the outlook is uncertain and the committee is attentive to the risks to both sides of its dual mandate. Though officials maintained key language in that statement that they have held since January that, quote, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. The central bank reiterated that inflation is eased over the past year, but characterized it as, quote, somewhat elevated as opposed to just elevated. Officials also noted that job gains have moderated and that while the unemployment rate has moved higher, it remains, quote, low. The decision was unanimous. However, Austin Goolsbee from the Chicago Fed filled in for Loretta Mester from the Cleveland Fed since she retired in June, and there's no replacement at this time. Back to you.
Jennifer, thank you very much. So largely as expected here in terms of no change, but also it did seem like there was a little bit of inching towards that loosening of language that might indicate a little bit more decisiveness for September. But Miles, obviously in the press conference, we'll see if we get more nuance on that front.
Yeah, it's nice that we get the press conference. You, of course, remember when we used to have this meeting come and go with no commentary from the Fed, the Fed chair at that time. So I think the word coming out of the statement that stands out to me is somewhat. And Jennifer called it out, where you have inflation remains somewhat elevated, a change from calling inflation elevated. So they kept the language around needing greater confidence on inflation readings to adjust their policy stance. I think that gives the Fed plenty of wiggle room with the July, coming next month CPI report, and then the August CPI report coming in September ahead of the Fed's next meeting. So you have two inflation readings there, plus a couple of PCEs mixed in that you can go to and say, all right, that's the confidence we need. But taking away that idea of inflation being elevated and calling it somewhat elevated is really, to my quick reading here on the desk, the most important change within that statement that, again, is opening that door that I think the Fed wants to walk itself through in 6 weeks.
Yeah, and we want to go back to Jennifer Schonberger now to see what else you want to flag from the statement or the interpretation of it, Jen.
Thanks, Julie. Just building on what you guys were just talking about there, the Fed had really a range of things they could do here. And what they ended up doing is just cracking the door open as opposed to swinging the door wide open, right? And I think to the prior person's comments that they said the characterized inflation is somewhat elevated says that they have seen progress on inflation, but they don't have enough of it yet to fully set the table for that rate cut in September. This signals to me that there's a lot of room between now and September where things could change, and they do not want to tie their hands. They want to make sure that the data continues to show progress for July and August. If we're seeing better data that come in line with what they want to see by the time we get to Jackson Hole, then Fed Chair Powell can really lay the groundwork. But to me, this is not a wide open, hey, yeah, we're doing it. They're saying we're cracking the door open at this point.
Let's bring in former Atlanta Fed President Dennis Lockhart to talk more about the task ahead of Chair Powell. And, Dennis, I was thinking back to your time at the Atlanta Fed. They only had press conferences 4 times a year when I began covering the Fed. I'm not sure if they had regular press conferences at all back when you took that post. It's a different era for Powell now. How do you think the chair is approaching, this moment, and how, I guess, really he's approached this whole cycle, knowing how often he is able to speak to markets to get them to where maybe he's more comfortable, with their pricing?
Well, I think one thing to keep in mind about this press conference is he has Jackson Hole coming up, and that gives him an opportunity to lay out a picture, if he chooses to do so, in a very comprehensive, very measured way. So he may not feel he has to say too much, even if the committee in the meeting today is leaning toward a September move. I'll also say that in my experience, it's hard in one meeting to talk about what you're going to do in the next meeting. And so it's quite possible the committee just really didn't form any kind of a view of regarding September.
And I guess especially at a meeting when the next one is pretty far out, right? It's not a close-in meeting. It's not until September. So given that, how do you expect Jackson Hole to be used by the Fed chair? Do you think that maybe by that point he'll have a higher degree of comfort about being more clear with the signaling for September?
Well, that's a really tough question because the chair can do a variety of things with the Jackson Hole speech. Can say nothing, can say a lot, can speak strategically or in terms of framework, or can really talk about relatively near-term monetary policy. Powell has described this next decision as really a momentous decision, a major decision. He may wish to, because of where the committee is at this time, not address that, but maybe talk in terms of the history we've seen since March of 2020 and the pandemic crisis hit. I really can't predict. It is a speech that has been in preparation for some time, and these speeches tend to be big picture, fairly comprehensive in trying to lay out a logic of some kind.
And I guess in thinking then maybe about the balance of the committee, those other 17 members over the next several weeks, how much consensus do you think those folks are likely to congeal around? Let's say as we get through the typical cycle, post meeting, folks are out in the field speaking to all kinds of different gatherings to make sure that there's like a very clear unanimity and support of the Fed cutting rates, because I don't know, if Jay Powell has really taught us anything, it's that he wants to make sure there is alignment, with his team before they do anything big, and certainly, to cut rates at this point in the cycle, is going to be seen as such.
Well, I'm not sure the voices that we hear between now and the September meeting will necessarily satisfy the market in terms of alignment. There could be quite a number of different views, but those views will be tactical. Strategically, this committee is aligned. There's no one on the committee who's saying the Fed is doing exactly the wrong thing. No one who's really suggesting a complete difference of priority between employment and inflation. Strategically or direction-wise, I think they all agree. What we may hear is different views as to the timing of the first cut.
I'm also curious about outside influences on the committee. And for once, I'm not necessarily talking about the election. I'm talking about everyday Americans. There was a new poll out from Morning Consult that said 68% of U.S. consumers said rates are too high right now. Of course, probably at least an equal number would still say inflation is too high. So make of that what you will. But I am curious what these guys are hearing in their districts and how they're taking that into account in terms of the decision making.
The district process over the years, and I'm told since I left, has continued to be refined in each of the 12 Fed districts, and they fairly systematically get views from corporate leaders and community leaders, and they do surveys. So I think the presidents are very definitely influenced by that. And in some respects, the information is more immediate than the data that they're looking at, which often mostly arrives with a lag. So the presidents are influenced, and the governors listen to what they're hearing. It does have some effect, but much of what is collected is not, strictly speaking, data, and therefore is viewed as sort of a second form of information.
And then I guess looking past that initial cut in September, I'm curious if you have any thoughts around, what the path over the next 18 months either could look like, should look like, what kind of destination we may be headed towards. And we've, seen the last couple dot plots more discussion on where that terminal Fed funds rate is. I'm curious how you're thinking about, really, I guess, the location, of our star at this point.
I don't think as they kind of nurture this soft landing that they're going to start from a first cut and then march to a neutral rate. I expect a more tactical approach where they make a cut and perhaps wait 2 meetings to consider the second cut. I think we're going to see more of a calibration approach than we're going to see a major shift in monetary policy to be accomplished in regular 25 basis point increments at each meeting. So I really would expect that they'll take their time often between cuts.
The Federal Reserve keeping rates unchanged, but the FOMC acknowledging some softness in the labor market. Joining us now, Greg Daco, EY Chief Economist, and Jeff Klingelhofer, Co-Head of Investments and Portfolio Manager at Thornburg Investment Management. Greg, I want to get to you first here, and thank you both for joining us. Let's talk about this new balance of risks here. In addition to the JOLTS report, we also got ADP this morning, and again, both showing, under the surface, some signs of labor market weakening. Do you think that the Fed is acknowledging that enough?
I think this is still a bit of a too shy of a wink-wink in terms of a potential rate cut in September. The Fed remains, in my opinion, too data-dependent and backward-looking in that regard. You've heard me talk about this in the past, but I still feel like we should have more of a forward-looking perspective. If you look at the totality of data, you're seeing employment gains slow. You're seeing the unemployment rate tick up. You're seeing the JOLT report, as you were referring to, indicating slower quits, slower hiring, slower job openings. Overall, the labor market is slowing, and inflation continues to move towards 2%. So we're in the environment that would require the Fed to start recalibrating monetary policy. I think it's pretty simple for Fed policymakers, but they're still erring on the side of caution, being, in my opinion, way too backward-looking in their assessment of economic conditions.
Now, Jeff, as I read your notes to us, I think you're a little more comfortable with the Fed maybe slow walking its process as we get towards September. And I guess as we've seen the markets, really aggressively decide September is going to be it. The Fed, we'll see how Powell kind of handles that in the next 15 minutes or so. But I'm just curious how you see the landscape and kind of what you think the Fed not only should be doing here, but really needs to do to keep the economy either in the place that it wants to be, or perhaps doesn't risk it getting into a vulnerable situation.
Yeah, I mean, as I read the Fed statement, I think the Fed did exactly what they were supposed to today. The market is a little bit too ebullient in terms of its belief that we are 100% priced for a move in September. And the reality is, there are better balance of risks. Inflation is coming down, but it's not this immaculate disinflation story. It's coming alongside with a weakening economy. My main contention is the Fed shouldn't be necessarily forward-looking because nobody has a crystal ball. I think the goal of monetary policy is to cushion a cycle, but not try to engineer a cycle. And the reality is the job market remains relatively strong, although weaker than it has been, and inflation remains elevated above its own 2% inflation mandate. So I think the Fed is appropriately on hold here. And I hope that what we see from Chairman Powell in the press conference is doubling down on needing to see more data that they are absolutely moving towards that 2% inflation objective. And I think we remain a relatively far ways away from having true confidence.
Greg, game it out for me. What would it look like if the Fed did nothing the rest of the year? I mean, obviously there's changing economic conditions, yada, yada. But if you had to say today and game it out what that would look like, what would you see?
Well, I think if we fast forward to the end of the year or potentially next year, we're going to be in an environment where you're going to see ongoing disinflation and a rebalanced labor market for which any further weakness would portend to slower income growth and a potential more significant pullback in consumer spending activity. You're already seeing businesses become more cautious. You're seeing signs of a slowdown in economic activity. If you have a higher for longer scenario, where the Fed does not start to ease monetary policy, you're going to see a tightening of financial conditions. Combine that with an environment where there's increased focus on the fiscal situation in the US with elevated levels of debt, high interest debt payments, that could portend to a negative feedback cycle where interest rates actually rise further from here, and that leads to a more pronounced pullback in private sector activity. I really believe that the Fed needs to be much more forward-looking, and I wouldn't be surprised that Fed Chair Powell, in his introductory remarks, talks about that greater confidence in the move towards 2%, and perhaps even signals in his press conference responses that there is openness to a potential rate cut in September.
Jeff, given I think where the market saw the Fed headed, really we came on the air and we're talking about the action today is NVIDIA. So looking at that rotation, look at what's happened kind of in the NASDAQ and elsewhere. I'm curious how you've looked at, not just the reaction to Powell or to the Fed statement today, which was not much of a reaction, but what we've seen in markets over the last couple of weeks, I think investors start to really grapple with this next phase of the cycle. And we can debate all day whether they should go now, November, et cetera, et cetera. But we've seen markets really start to change their behavior. I'm curious how you've thought about that.
Yeah, I don't think it's really connected to the cutting cycle or potential cutting cycle of the Federal Reserve. I really think it's just markets got far too ahead of themselves of pricing in the significant growth runway of AI. And what we've told clients for some time is absolutely AI is very likely to change the world, but it's not going to change the world today. And I think over earnings reports and companies we talk to, what we haven't seen is a transition from the build out to actual use cases. And so the risk to that is maybe the build out is a little bit slower and some of those estimates of forward growth have to come down. But on the flip side of that rotation is the significant move we've seen in small cap stocks, and that is premised on a belief from markets that the underlying economy remains incredibly, incredibly strong because it's small caps that should sell off, should face the most pain if the economy truly does weaken. And so I think the Fed is really it's the uncertainty. It's the uncertainty of if we're heading into any potential slowdown, how deep that slowdown will be, also, and if inflation continues to come down, and the Fed should stay pat, but that underlying rotation, we, the markets, are paid to take forward-looking views. I think the Fed isn't.
Ann Barry joins us now, Threadneedle Ventures founder. Ann, what did you make of what we heard from Powell? What do you make of the market reaction today? Obviously, we've had a lot more in markets today outside of the Fed world, I think, is really driving the action. But as we sit here, pretty much now locked into waiting the next 6 weeks for the Fed to just get on with it. What were your thoughts on both what Powell said today and ahead of this? Did you feel like, July should have possibly been on the table for the Fed?
I don't think July should have been on the table. And what I heard was classic Jay Powell preserving optionality. We heard a lot of conversation, a lot of data, which basically points to this being a Goldilocks economy at this point. And they basically said it. It feels not too hot. It feels not too cold. We've got inflation coming down towards our target. At the same time, unemployment isn't, we're not hitting cliff levels in the labor market. So I don't have the same conviction that the market has that there is going to be a rate cut in September. I did not hear that there was a catalyst that would make that a done deal. I think we're still in wait and see. I think there's still a chance that we're flat in September, just as we were today.
So, Ann, your business has touched a lot of different aspects of the economy. Do you agree with the assessment that a hard landing is not in the cards and that this is a Goldilocks situation?
I do think a hard landing is not in the cards. And I think the big thing, Julian, I remember you and I talked about it last time I was on your show. We talk a lot about the headline rate, as we've done today. There's a piece of this that we don't talk about. And I want to point to an op-ed that Kevin Walsh wrote in the Journal, which I thought was phenomenal reading yesterday. We don't talk about the size of the Fed balance sheet, which is now north of $7 trillion. And the reason it has become so big is because federal spending, fiscal profligacy has been so enormous that the Fed has accommodated by buying a bunch of long-dated government bonds. So we haven't seen rates really come down as much as you might expect when it comes to long-dated treasuries. And I think as we go headlong into seeing what fiscal policy is going to look like for the next 4 years, Julie, I think that's the bigger concern right now. I think that remains, frankly, an inflationary pressure, and I don't see rates coming down yet as a result.
So in other words, you think even when the Fed does begin cutting, that, long and variable lags that we've been talking about on the upside for rates, forget about that. I mean, it'll be really long and variable lags because of that cushioning effect you're talking about?
Well, I think there's a couple of things, right? We're going to see continued inflationary pressure if we don't see fiscal policy get reined in. Over the longer term, we've seen this decline towards 2% now, but if we see federal spending bump back up again, or at least not come under control, if the deficit continues to expand the way it does, we're going to see upward pressure on inflation again, and as a result, we probably want to see that filter through into Fed policy again. So, I think the Fed's going to tread very cautiously at this point, Julie. If there are cuts in September, again, I'm not convinced there are going to be. I think they're going to be small, incremental 25 basis point changes as Fed Chair Jay Powell treads extremely carefully going into a new administration.
So, and I guess if you take all this together, it really seems like, in your view, the Fed has a much more challenging task ahead of it rather than just figuring out what the target range for the Fed funds rate should be. And I guess it would track then that you go from rates at zero, you raise rates most aggressively we've seen in 40 years. You're not just going to get out of it in 12 clean months. And it feels like when you take a step back, the Fed is in a much more precarious position over the next several years than maybe the market's focus on mid-September this year might otherwise suggest.
I think we've got to sort of ask ourselves, what are the cards that the Fed has got to play at any point in time? Right, it's got the headline rate, and it's also got the size of its balance sheet and whether it's shrinking or expanding its balance sheet, putting liquidity into the economy. If the Fed starts cutting now, and we have another shock to the system, and we've had a couple, right? We've had the pandemic, we've had political instability. Who knows what we're going to have next? You kind of ask yourself, what levers has the Fed got left to pull? It does need to have some tools at its disposal to have some buffer in the case of exogenous shocks. Now, if right now we have this Goldilocks-ish economy, which they basically said in so many words in the presser today, it does beg the question, why rock the boat right now? Just because the market's expecting a cut doesn't mean that they have to deliver one. They have to keep looking at the data. And I think this is where, at least despite the criticism, Jay Powell's been extremely consistent. When and only when they see that 2% target right there on the immediate horizon, are rates going to start to move?
Good afternoon. my colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance. and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make the? Sorry, thank you, sir. How do we figure out in the months ahead? Is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So, a couple things. A good place to start is the SEP. But let me start with what I said, which was that we're going to be making decisions meeting by meeting, based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we are contemplating. Again, I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
Go to Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of opinion, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year?
Yeah, we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina.
Hi, Chair Powell. Gina Smilik with the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in a solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there, but so I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level. And we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply? Or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. Meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So that's our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So. And policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be, their wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person, as measured. It's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, that could go on and on. There are many, many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change, particularly over the last few months. And so what we say is, as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. No, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed the unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. And some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question. You mean after we get through all of this? Yeah. It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me, and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. It's, again, we only know it by its works.
And one more, how do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so, this is my 4th presidential election at the Fed, and, it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve. And we do that, and we make a decision as a group, and then we announce it. And that's always what it is. It's never about anything else. Nothing else is discussed. And I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind, and it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not doing, we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels. But they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this. But, the direction of travel is clear, and as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not, obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to find, to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Hi, Victoria Guido with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is let's look, at this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we literally everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had the highest, we had a burst of inflation. Many other countries around the world had a similar burst of inflation. And when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. You know, we just keep it low, keep it stable. We're restoring that. So what we're going through now really, it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on. And I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
Greg.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. You know, the Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? You know, after the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks they get lower inflation. And so we're not, we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So, the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Okay. And is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday there were merger reform finalizations from the other bank regulators. Well, what does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage, so very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today was, I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't, as I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No. Thank you.
50 basis point rate cut. The Federal Reserve slashing its benchmark interest rate by a half a percentage point to a new range of 4.75% to 5%, marking the first rate cut in more than 4 years. Now, Fed officials see 2 more 25 basis point rate cuts this year, followed by 4 more cuts next year and 2 more cuts in 2026. Breaking down what officials saw, 9 officials saw 4 cuts this year, so that includes the 50 basis point rate cut today. 7 saw 3 cuts. 2 officials saw 2 cuts this year, and 1 saw 5 cuts. Now, officials say in their statement they are gaining confidence that inflation is moving sustainably back down to 2%, saying, removing the word some, and now saying instead that inflation has made, quote, further progress towards the Fed's 2% goal. The statement also reading that, quote, the committee has gained greater confidence inflation is moving sustainably towards 2% and judges that the risks to achieving its employment and inflation goals are roughly in balance. Now, future rate cuts will depend on the evolving economic outlook as well as the incoming data and the balance of risks. The outlook for interest rate projections come as Fed officials now see the unemployment rate rising to 4.4% this year and holding at that level over the next couple of years. That's up from 4% previously forecast. At the same time, economic growth is seen at 2% this year instead of 2.1% previously forecast, and officials expect the economy to coast at that 2% level over the next couple of years. As for inflation, they moved down their inflation outlook. They now see inflation ending the year at 2.6%. That's down from 2.8% previously, and then moving down to 2.2% over the next year. Now, there was some division on today's decision. It was a split vote. It was not unanimous. Fed Governor Michelle Bowman dissented, saying that she would have preferred to have cut rates by 25 basis points instead of 50. This marks the first dissent in 2 years. I was a bit surprised. I know we saw some media reports floated Friday, Monday, sort of setting the stage for the potential for 50. I was surprised, though, because to your point, yes, we've been hearing from a lot of strategists, but other Fed officials coming into the blackout period did not seem to point towards a larger jumbo cut today. They seem to think that the data would point towards more of a 25 basis point rate cut, and they would take more of a gradual, measured approach. That is what I heard from Fed officials I personally talked to. So now the question becomes, is the Fed behind the curve? Is this a proactive move? It's curious to know whether this was a move, a sort of preemptive move to stave off further weakening in the job market, something certainly that Fed Chair Powell had alluded to back in Jackson Hole the last time we heard from him, and whether this is to preserve the soft landing scenario.
We were in the dovish 25 camp here. So surprise on the left-hand side, meaning on the front end, 50 basis points, but then not a surprise on the back end, 100 basis points next year, 100 for the year after that, a little shallower, bringing it down in terms of rates, and the terminal rate slightly higher by an eighth, if you will. And I think the very clear, like one of the things that was changed in the SAP was the unemployment was higher by about 0.4. So clearly remains the focus remains still on the unemployment side versus the second mandate, which is inflation. So slightly surprising on the front end, but then not so surprising on the back end. So steepening reaction from the bond curve is very, very legitimate at this point.
Vishal, now all eyes turn to Jay Powell at this presser. So let's say, Vishal, I'm going to make you a reporter. You cover the Fed. You're in that presser, Vishal. What would you ask Jay Powell? What's top of mind?
Playing the 50 basis points, I think that is the main thing right now. Is it a make-up 50 basis points? Because if you think about it, just rewind the clock back to the blackout period started on Monday. At that point, going into it, we were very clear, and the market was very clear with the dovish 25 basis points being the outcome here. So that change in thought process from that until today, I think that 50 basis points, if you will, market would require a little bit of that explanation, and then the explanation of the back end as well of why shallower is the confidence more in the soft landing sort of camp, or is it that a little bit of that catch up or make up that we are slightly behind the curve here to start off. So definitely that is top of mind for me at the moment.
Vishal, does this make you think twice about the soft landing camp, but whether or not you're confident that we are going to see a soft landing?
You know, from the data, that we are tracking, and then the Fed also sees the same thing. I think definitely cooling or rebalancing. This is very clearly in our minds a recalibration cut cycle rather than recessionary cut cycle that they're getting into. And the timing is right. Maybe they were off by a meeting or two, but they have a lot in their toolkit. I think we are not even talking about balance sheet at this point. We have 550 basis points, or maybe just 500 at this point to go, but still a lot in the toolkit. So given that, and then you marry it with strong balance sheets on the consumer and corporate side that we are coming here at this point in the cycle with. So those two together, still our confidence is very high for a soft landing.
Even, Vishal, there was some kind of speculation out there, and this is from folks who thought Jay Powell wouldn't do 50, because they said if he does 50, the initial reaction may be positive, and muted positive reaction right now. Major averages up in the green, but then investors might think twice. They might think, well, why is the Fed doing 50? Why is the Fed doing a supersized cut? Maybe they see something in the data that we don't. What do you make of that argument?
No, definitely that we had the same discussions even this early as late as this early morning today as well, in terms of the pros and cons for 25 and 50. I think the back end dots have really helped that argument or present that argument very cleanly. They did not tinker too much with the statement. I know there are still a lot of red lines, but not drastic changes from the statement or surprising statements, changes in the statement. And then I think they re-brought that point back up into the focus that unemployment still remains their primary focus. So, trying to give us the dovishness there, but not trying to show us a lot more nervousness with the shallower path of decline in rates over the next 2 years. So I think it marries or it levels off some of that fear that we also had, that a 50 basis points will bring out. What does the Fed know that we don't know? But I'm sure probably the first or the second question in the presser will be about that in terms of explaining the background on that 50 bits.
The Fed just go with the supersized route, half a point. Was that your expectation, Greg?
It was not my expectation. I was expecting gradualism would win the day, but the Fed decided to go big or go home. I think that shows that Fed Chair Powell, who was the leader in terms of this openness to larger rate cut, managed to convince his colleagues, who up until very recently were talking about a methodical approach to easing monetary policy. I think that is the right decision, though, even though that's not what I was expecting. I think going larger with a 50 basis point rate cut allows the Fed to catch up to where it should have been in terms of placing monetary policy in a much better strategic position, approaching the slowdown that we're starting to see in the labor market.
What do you think, Ed? Do you agree? Does 50 make sense?
50, whether it is this time around or 225s, in my mind, it doesn't make any difference. I think it's about the 100 basis point reduction over the longer term. But this does raise a question for me. Historically, 50 basis points came before a recession or fears of a recession. So this voiceover, is this the time where that is no longer the indicator it used to be? Or do we hear from Fed Jay Powell that things are weaker than we thought?
As Greg is the resident economist here, when you look at the economy right now, do you see cooling, or do you see something more ominous on the horizon?
I see something of a softening in terms of economic momentum, not a retrenchment. The key reason, and we've talked about this in the past, is because the labor market is not showing any signs of a retrenchment. You're still seeing employers valuing the value of talent. You're not seeing any broad-based layoffs. That's still supportive of steady growth in terms of employment, which in turn is supporting income and in turn consumer spending. But when we think about the economy, the Fed has to be a bit forward-looking. So what it's doing right now is catching up to today's economic conditions, because I think it was behind the curve, focusing too much on old data and the fear of inflation reigniting, and now adjusting its policy setting to be able to more strategically respond to any further slowdown in economic activity. I'm a little bit surprised, to be honest, that it's only showing, that dot plot is only showing 100 basis points of rate cuts since they went with 50 at this meeting, because that means only 2 25 basis point rate cuts. How is the Fed going to communicate this intent to go back to 50 to 25 basis point rate cut increments at the November and December meeting?
And do you think, when we talk about the rotation that certainly has started to take place, and we talked about the inflows, especially over the last couple of weeks, into more of the defensive plays, when you talk about real estate, consumer staples, utilities, a cut like this with 50 basis points, we're seeing the Russell 2000 spike just a little bit here. Is that going to then add a little bit more juice to that rotation that we've already seen
I think it really depends on what the voiceover is. Is this 50 basis points because Jay Powell made the judgment that the consumer needed the help? Or was it 50 basis points because the assumption was the consumer's really resilient, actually the economy is doing a little bit better than we thought, and inflation is under control, so let's give it the juice while we can. Until we get clarity on which way the argument falls, I think it's very hard to know how this rotation is going to play out.
Do you think, are there risks, Greg, to going 50 that you can see? You've laid out kind of the positive case. Would there be risks that you think investors need to consider?
I don't believe in the risk that the Fed is signaling anything that we don't know about. If anything, the Fed has been extremely...
That was one question, whether investors would say they would do 50 and people would say, yikes, Jay Powell must see something.
They're not panicking. I think Fed Chair Powell is very much aware of the situation in terms of the economy cooling, not falling off a cliff. And this type of rate cut is really a catch-up effect of realizing that both sides of the mandate are now as important. That was in the statement, equal weight to both sides of the mandate, and that we have to pay a little bit more attention to the slowdown in the labor market. So I don't think this is a signal of any reason to panic, but I do think it's very important that the Fed and Fed Chair Powell during the press conference focus on a forward-looking framework. Data dependency is done. We should get rid of that and now focus on a forward-looking perspective and have Fed Chair Powell communicate where they believe neutral monetary policy is, not in 4 years, which is in the dot plot, but today, and how do we get there?
Greg, what is your assessment of the labor market? Because when you take a look at these projections, they're now seeing unemployment at 4.4% compared to just 4.2% today. Not significantly more weakness, but is this something that investors, that economists are a bit worried about?
I do think it's something to be concerned about. I mean, we have rarely seen, and you mentioned that, we have rarely seen an environment where the unemployment rate just rises gently and then stops and then comes back down. Generally speaking, there is momentum in a rise in the unemployment rate. That's why we have the SOM rule. That's a good indicator of historical downside risks to the economy. And I think we have to keep in mind that while the value of talent has increased and while employers are being very cautious with who they hire, how they hire, and how much they lay off, there is still the potential for a more pronounced slowdown in economic activity and a more rapid turn up in the unemployment rate. And I think one key highlight in the latest projections is the fact that the unemployment rate was revised up by 0.4. That's a massive upside risk in terms of the forecast.
And there was one school of thought out there by some market watchers which said Jay Powell was going to cut 50 because the financial markets expected 50. And Jay Powell didn't want to wake up tomorrow morning, have a cup of coffee, open the paper and say, and the headline is, Jay cut by 25, disappointed, stocks plunge. What do you make of that?
I think Jay Powell's been pretty immune to that sort of pressure to play to the market's expectations.
It's water off a rock. He doesn't feel it.
And I think that's his superpower. I think that's been his strength. And I think there's, there are two forms of pressure. There's the pressure of Wall Street expectations, the pressure of accusations around jumbo cuts before the election, right? That's another pressure we haven't talked about. I think what he's done there...
Do you expect political blowback on that?
I do think there's going to be some discourse around it, for sure. Again, let's see what he says in the presser, because he may be able to take the edge off it. But I see it a little differently. By doing 50 now, I think he's bought a little bit of time. Right? Imagine if he'd done 25, the data came in saying things aren't looking so great, and then he had to do 50 later. He'd have the same criticism as he had, right, on the way up here. So I think the fact he's one and done, I think he's a one and done for a minute right now, I think helps him.
And he also mentioned that at the Jackson Hole meeting a few weeks ago. Let's not forget that. His speech was very open in terms of the trajectory of monetary policy, very different than his colleagues who were talking about, we're going to go methodically, we're going to go gradually. He did not mention gradualism.
Do you give Greg a high grade to their communication strategy? Because some economists, not such big fans.
No, I don't think the communication strategy has been good at all. If anything, I think up until this weekend, where everybody was pricing in a 25 basis point rate cut, then you had a couple of news articles that started floating some speculation as to a 50 basis point rate cut. I think that is a sign of poor communication. I think there needs to be much better communication of, as I said earlier, the monetary policy framework, which needs to be forward-looking and not data point dependent, which it still is. And two, communicate the intent of where we're going in terms of monetary policy from a policy neutralization perspective and how rapidly we'll get there.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 1/4 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer-run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Thank you. Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Chair Powell, Nick Timrose from the Wall Street Journal. Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
So I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long bond rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. Ultimately, I'm sure we've all read these decompositions of what and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent and if they're material. Then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
If I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now?
You get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. Let's talk about the data we've gotten since the last meeting. So in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly the September employment report was stronger. The October report, not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular, and so overall feeling good about economic activity. So I think we would factor that in. At the same time, we got one inflation report, which it wasn't terrible, but it was a little higher than expected. So I think really the question is December, and by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and we'll make a decision as we get to December.
Gina Smilik from the New York Times. Thanks for taking our questions, Chair Powell. When it comes to December, what will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you give a little bit of detail as to why?
You know, we don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December, we're going to be, again, at every meeting, we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? You know that we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September and in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, we're going to wait and see how things come in December. I mean, it's just, I would put it this way. We're on a path to a more neutral stance. And that's very much what we're on. That has not changed at all since September. You know, we're just going to have to see where the data lead us. We have, you know, a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but you know, I would say, I would say that, you know, again, we didn't update the SEP, so I'm not going to characterize, you know, where the committee would be.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate and explain a little bit the 2 changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress, and in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation in the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we met that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. You know, there's a fair amount of uncertainty in what I've said. The path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find the right pace and the right destination as we go. And I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates, and are rising deficits a concern to you?
So we don't comment on fiscal policy, and again, I don't have a lot more to say on what's driving bond yields. In terms of of policy changes, though. Let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outlines, so we'd start to model it. And then we'd wait, and then at a certain point, the staff would brief the FOMC and say, you know, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that, and then the law actually passes. And you know, you'd start to put it. You'd probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So, you know, we have a very large economy. Many things are affecting it at any given time, and you know, a law change of some kind would go in there, but it would go in. But it would, you know, it's a process that takes some time. Clearly, the legislative process takes a lot of time, and of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And you know, the overall effect on the economy at any given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration, constantly. And this will be no different. But you know, right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of, you know, when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question, are the current rates something you feel like you need to lean against, in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
I just think the first question is, how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions, only to find, you know, 3 weeks later the 10-year was 50 basis points lower. So, you know, it's material changes in financial conditions that last, that are persistent, that really matter. And we don't know that about these. What we've seen so far, you know, we're watching it, we're reading, you know, we're doing the decompositions and reading others, but right now it's not a major factor in how we're thinking about things.
Thank you, Chris Rugaber at Associated Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw a stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop.
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome. But, of course, our mandate is maximum employment and price stability, and we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate. And we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago, and we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress, and today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market even as our policy stance enables further progress toward our inflation goal.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that path? Thank you.
So we haven't, you know, made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but it's something that we're just beginning to think about.
Edward.
Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So yes, we look at all of them, right? But if you look at 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we also look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from? So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are, market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation? You see that catch-up inflation also in insurance and several other areas. So you're seeing, we're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be 1 or 2 really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
Hi, Chair Powell. Craig Torres from Bloomberg. 2 questions today. Did you learn anything about what Americans think about the economy from the election results? First question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the election. On the second one, this is the great question, and it's the one we think about all the time. So I'll just say a couple things. There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's moved up significantly from a year or so ago. So we've seen a big change upward in unemployment. Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool, but it seems to be in a good place. And our policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market while also enabling further progress on inflation. You mentioned a bunch of indicators, and you're right. The openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you can say it the other way, that wage increases are now consistent with 2% inflation given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years. But it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. We don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Hi, Victoria Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Michael McKee from Bloomberg Radio and Television. You talk a lot about what the data are telling you and how you are dependent on the data, but in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much of a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty strong, and you're seeing 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global peers. And I think that is reflected in what you hear from, what I hear people hear from CEOs. I don't get to talk to a lot of CEOs in my job, but I hear what others summarize from those. And of course, I hear the Reserve Bank presidents do a lot of that. And it's pretty constructive overall. Now, that's not to say there are areas of caution and things like that, but ultimately, overall, pretty positive.
Well, to follow up, the areas of caution, if there were black clouds on the horizon that you identified as something you're watching, what would they be?
I think it's things like, clearly geopolitical risks around the world are elevated, and just as clearly they've had relatively little effect on the U.S. economy. Now, that can change through the price of oil or otherwise, but people talk about those as something that's on the horizon all the time. But ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people, and expectation that will continue. If anything, people feel next year. I've heard this from several people that next year could even be stronger than this year.
Hi, it's Andrew Ackerman with the Washington Post. I just wanted to follow up on the discussion earlier on fiscal policy. Your predecessors, Greenspan and Volcker, spoke up loudly when they thought large budget deficits endangered economic or financial stability. Will you do that too? And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are rising. Is that something you'd speak out against?
So, I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that in, you've got a very large deficit you're at full employment, and that's expected to continue. So it's important that we, that to be dealt with. It is ultimately a threat to the economy. Now, I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just said it again.
Okay, thank you. I guess the other question is, to follow up on Victoria's question, do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Not what?
Not permitted under the law.
Thank you.
Courtney Brown from Axios. In response to Howard's question, you said it wasn't an ideal time to give forward guidance because of the economic uncertainties. Can you lay out what some of those uncertainties are, and whether or not it includes some of the proposals that the president-elect has put out on the campaign trail? Tariffs, for instance?
No, I was not referring to the new administration's policies at all, nor will I today. So what I'm just saying is, as we look ahead, we know, and I mentioned this in my statement, that the risks are two-sided. I guess I should start by saying that we think that the economy and we think our policy are both in a very good place, And but as you look forward, you say, what are the risks? And one risk is that we would move too quickly and find ourselves having moved too quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk. And to avoid that risk, that means you want to move carefully. The other risk is that we move too slowly, and that we allow the labor market to weaken too much and do unnecessary damage to the labor market and to people's working lives. That says don't get behind the curve. So these two things are the two risks that we have to manage. And so we're in the middle there. We try to be in the middle and deal with both of manage both of those. Again, the idea is to support the strength we have in the labor market and in the economy, but also with somewhat less restrictive but still restrictive policy, enable further progress toward our 2% inflation goal. This is a thing we're meeting by meeting, we're going to be making our assessment of what the right path is. You know, it's not as important. The precise timing of these things is not as important as the overall arc of them. And the arc of them is to move from where we are now to a sense of neutral, a more neutral policy. We don't know exactly where that is. We only know it by its works. We're pretty sure it's below where we are now. But as we move further, there will be more uncertainty about where that is. And we're going to move carefully as this goes on so that, you know, we can increase the chances that we will get it right.
Thank you, Chair Powell. Simon Rabinovich with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that longer-term inflation expectations do seem to have risen up at about 2.5%, for example, on the 5-year. That's up half a point from when you cut in September. Do you have any concern at all that longer-term inflation expectations are de-anchoring, or put another way, are anchoring at a slightly higher level? Thanks.
So we would be concerned if we saw, if we thought we saw longer-term inflation expectations anchoring at a higher level. That's not what we're seeing. We're still seeing between surveys and market readings broadly consistent with, you know, I looked at the 5-year earlier today, and it's probably moved, but it's just not. It's kind of right where it's been, and also it's pretty close to consistent with 2% PCE inflation. So that's one that's been a traditional one that we look at a lot. But overall, expectations seem to be, and really have throughout this, in a place that's consistent with 2% inflation. But you're right to say we watch that very carefully, and we will not allow inflation expectations to drift upward. But that's really why we reacted so sharply back in 2022 was to avoid that.
Hi, Chair Powell. Kelly O'Grady, CBS News. We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And the world went through a global inflation shock, and inflation went up everywhere, and you know it stays with you because the price level doesn't come back down. So what that takes is it takes some years of real wage gains for people to feel better, and that's what we're trying to create. And I think we're well on the road to creating that. Inflation has come way down. The economy is still strong here. Wages are moving up, but at a sustainable level. So it's just, I think what needs to happen is happening, and for the most part has happened, but it'll be some time before people, you know, regain their confidence and feel that. And you know, we don't tell people how to feel about the economy. We completely respect what they're feeling. Those feelings are true. They're accurate. We don't question them. We respect them.
And just a quick follow-up. President-elect Trump has been critical of your performance. Any concern about his influence on the Fed's independence?
I'm not going to get into any of the political things here today, but thank you.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. What is your plan if we start to see stagflation?
Well, so that's the whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan. You know, it's of course a very difficult thing because anything you do with interest rates will hurt one side or the other, either the inflation mandate or the employment mandate. I would just say that, you know, we've been able to see inflation come down a whole lot, you know, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So, knock on wood, we've gotten this far without seeing a real weakening in the labor market, and we believe we can complete the inflation task while also keeping the labor market strong, and that, of course, is exactly what we're trying to do.
Can you rule out an interest rate hike next year?
No, I wouldn't rule anything out or in that far away, but that's certainly not our plan. I mean, our baseline expectation is that we'll continue to to move gradually down towards neutral, that the economy will continue to grow at a healthy clip, and that the labor market will remain strong. If you look at our that will not change from the September SEP. That is our baseline forecast, and short of some exogenous event, that will continue to be our forecast for the foreseeable future. So, but ultimately, we're not in a world where we can afford to rule things out a full year in advance. There's just too much uncertainty in what we do.
Let's go to Jean for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to go back to a comment that you had made about Americans being quite unhappy about the cumulative price level rises over the past few years, even though now inflation is back on a path to 2%. Would it be appropriate for the Fed to undershoot for a while on its inflation goal under the average inflation targeting regime, so people have a chance to catch up?
No, that's not the way our framework works. We're aiming for inflation at 2%. We did not think it would be appropriate to deliberately undershoot. And part of the problem there is that low inflation can be a problem too, in a way. But that's not part of our framework, and it's not something we're going to be looking at in our framework review. Thank you very much.
25 basis point rate cut, the Federal Reserve lowering its benchmark interest rate by 0.25% to a new range of 4.5 and 4.75, marking the second cut in just 7 weeks. Officials justifying this new rate cut to maintain their dual mandate of full employment and price stability. However, they did remove key language on inflation in the statement that, quote, the committee has gained greater confidence that inflation is moving sustainably towards 2%, raising questions about the pace and number of future rate cuts. Instead, the policy statement simply reads, quote, the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Now, officials noted that the economic outlook is, quote, uncertain, and that they are paying close attention to the outlook for inflation and the job market. Other tweaks to the policy statement. The Fed removed the word further in the first paragraph of the statement as regards to progress on inflation, saying that, quote, inflation has simply made progress instead of made further progress toward the committee's objective. The Fed also tweaked language characterizing the job market, noting that conditions in the job market have, quote, eased and that the unemployment rate has moved up but remains low. The Fed chair did not want to show his hand at all on December and whether a rate cut is still in play. He kind of seemed to say that both sides are on the table. He really wanted to keep his options open. He says the outlook for the path hasn't changed in that the baseline is still downward. They are still looking to cut rates to achieve their dual mandate. He characterized the labor market as solid and still seems to think that inflation is moving back towards their 2% target, and the fact that they removed key language in their statement today surrounding that sort of put an exclamation point around having achieved that test, that they have gained the confidence that they need, that inflation is falling. Today's rate cut was another move towards the recalibration.
The 25 basis points certainly was expected. Very little change in the statement from my perspective. And I think if any lane hawkish, it simply is in the context of an FOMC that sees uncertainty ahead, and they're going to keep their options open.
Do you think that there is more uncertainty today than there was on Monday? In other words, do you think, is the uncertainty just what we're seeing in the economy? Is the uncertainty more of the fiscal variety? How are you sort of judging those risks?
So I think it is really a combination of things that makes now an uncertain time. Obviously, this is a committee that is trying to judge where an equilibrium is in our economy in terms of how many rate cuts, how fast they need to go. They see and have seen for some time fiscal issues ahead. And certainly when you have a new administration coming in, a new Congress, they'll be thinking and watching carefully how any new policies may come to bear on the economy.
And Esther, what do you think the rate path looks like from here, December, January, and is it more cuts? Is it a pause? If it was a pause, what would that depend on?
Well, the pause could come if there was any unexpected data that would surprise, but my guess is they will be pretty steady in thinking about what was already in play. It's too soon, I think, for them to know what changes lie ahead for 2025. So I think you could see another rate cut in December. And then I think the path is really up for grabs, depending on how they hear the potential for policy. We're watching the 10-year, which continues to show some upward pressure. And I think this is a committee that understands they're not yet achieving their goals. They still have inflation over target. They're happy with the labor market where it is, but they have more work to do.
I'm glad you brought up the 10-year because we have been watching it and talking about it a lot, the fact that it is moving upward while we are seeing rates go down. And a lot of folks talking about that that's reflective of the optimism about economic growth, some talk also about fiscal policy and that effect. As someone who was inside that room, how much is the committee watching yields and watching the bond market?
Well, you watch them very carefully, and of course they can move around, but what you're looking for are indications of how tight or how easy financial conditions are and what expectations lie ahead for this committee as they set their forecast. You know, we'll see in December updated individual forecasts that will come out in the dot plot and have a better sense of how this committee is thinking about the path ahead. So I think that's going to be important here because they are watching financial conditions very carefully.
Can I ask you, Esther, what is the right level of rates? What is the final stop for the Fed here? Is it, is it around 4? Is it 3, Esther, lower?
Well, I guess we all are looking for the answer to that, as are members of that committee. And as Chairman Powell has said on a number of occasions, we'll know it when we see it. We have to sort of see how the economy settles out. It's why I worry a little bit about focusing too much on soft landing, because that, in fact, is not the objective for the Fed. The Fed has very clear mandate around its inflation target and employment. So it's really wrestling with those variables to judge when they think this economy has reached an equilibrium. So is it as high as today? Not likely. Will it be higher than we saw over the past decade? I suspect it will be.
When you look at this statement, I mean, as we talked about, not much surprise in the actual cut. What stands out to you from the statement?
I think the statement reads a little bit more hawkish. There were a couple of interesting developments in the statement. The removal of further progress, the removal of the confidence statement, gain further confidence that inflation is moving towards 2%, and the removal of the progress statement in terms of the balance of risks and inflation. Those are a bit more hawkish. Perhaps there is some positioning for an environment that may be a little bit more inflationary as we navigate into 25.
Set the table for a pause in December?
I don't think a pause in December, but perhaps a little bit more optionality when it comes to the direction of travel of monetary policy going forward. I still believe December is likely to be a meeting at which the Fed decides to cut by 25 basis points, but there is a lot of uncertainty regarding 2025, and perhaps this is opening the door to more optionality next year.
Not a lot of surprises. Of course, we were also expecting 25 basis points, and I agree with Greg that the statement was modestly more hawkish, and I think that was probably a smart move from the Fed. You know, what you've seen since the last cut is this historical backup in bond yields, almost 80 basis points higher since the Fed cut. That's very, very unusual. There's been a few factors that have led to it. One has been slightly better than expected economic growth. I wouldn't say it's great. I would say we've seen good economic growth. And of course, you've got this pricing in of the potential for more fiscal stimulus, extension potentially of tax cuts, all of those pro-cyclical policies coming into the price here. So it's almost like the bond market has been doing the Fed's job for them in a way, in terms of keeping the economy from seeing any type of significant downturn. And the Fed may want to use their words carefully here in order to remind us all that, they are seeing some cracks in the economy. They're seeing cracks in the labor market. Inflation's coming down, and that does warrant some cuts. And maybe we see a little bit of relief here in terms of that backup in bond yields.
Well, to Emily's point, RJ, with the yields remaining high and even moving higher here, does that also kind of work at cross purposes of what the Fed is trying to achieve? Does that make their job harder?
Well, I would agree that the tone of the statement, it does cut just a slight bit more hawkish than the predecessor statement. In terms of what bond yields have been doing lately, I view it clearly the economy has been resilient. It's not fading that much. The labor markets are relatively firm. The fact that yields have risen so much since the last Fed meeting tells you a couple of things. One, 50 basis point ease, which was a bit of a surprise last month, or back in September, excuse me, that actually helped to diminish even further the prospect of any recessionary risk in the very near term. And then secondly, the markets were reacting to the betting markets and the probabilities heading into the election that a stimulative red sweep was going to result, and that's probably what we're going to have. So does this work at cross purposes to the Fed? The Fed is working to secure a soft landing. If in fact fiscal policy resumes a rather stimulative footing, that also helps to secure a soft landing. So the Fed's amount of easing going forward should be a little bit less if in fact we get the kind of stimulative policies out of the Trump administration and a potentially Republican Congress.
Greg, I want to bring you back in here. On inflation, we know they say remains somewhat elevated, which was interesting because I was talking to Julie at the top of the show. I mean, headline inflation has fallen, of course. Core inflation maybe a bit more mixed, where we were at the beginning of the year, where we are now. Where do you see it headed from here?
I always talk about the fundamentals, right, when it comes to inflation. And what we see in the fundamentals is still disinflationary pressures. We're still in an environment where consumers are being price sensitive, where businesses have less pricing power, and where you're seeing strong productivity growth. We had strong productivity growth this morning as of the third quarter. So these are disinflationary dynamics that will continue to play out. I think it is still the case that inflation is slightly above the 2% target, but we're talking about a couple of decimals at most. PCE inflation is at 2.1%. Core PCE inflation is at 2.3 if you look at shorter term measures, 3 months, 6 month annualized.
Can I ask you, Greg, are there upside risks that you see to that?
Yeah, there's certainly upside risk. I think both cyclical and structural upside risk to inflation. Cyclical, we can talk about the potential for more tariffs. We can talk about the potential for reduced immigration, pressuring labor costs. But also on the structural front, there are also questions in terms of an aging population, putting more pressure on government spending and being inflationary. More structural pressure coming from the de-risking of the global economy and building resilience. More pressure also coming from an environment where you're seeing decarbonization of economies around the world. These are structural pressures that likely will put some upward pressure in a context that is geopolitically extremely sensitive. We should not forget the wars that are still happening around the world that could pressure oil prices, for instance.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina Smialik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year? And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals, maximum employment and price stability. We see the risks as two-sided, moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. But 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask you a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path. First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I would say it is this: some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation, September and October. As I mentioned, November is back on track. But once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still, going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation. As I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were two simulations. One was seeing through, one was not. And I'd point you. There's some language in the see-through paragraph that says, it considers situations in which it might be appropriate to see through inflation, and then names some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding again the ways in which tariff-driven inflation can affect tariffs can affect inflation in the economy, and how to think about that. So we've done a good bit of work. All of us have, each of us has, And it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that. That may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling, so far in an orderly, gradual way, but it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly that distance has shrunk by 100 basis points. So it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests again that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policies so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts, included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates, and we made look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. Again, you do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago, but it's nonetheless steadily coming down as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. I mean, a good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight. But overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to, to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on, and our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. And job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So but you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think you pointed out participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market, and it's because things have just gotten a little bit better. It doesn't unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive?
So what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. If you had a situation where inflation's moving around by a tenth every few months, that's, we'd have to weigh that against the fact that inflation has, in recent months, been moving sideways in the 12-month window. And so we've got to weigh them both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks to the two are, we think, are broadly, roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase, and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I think I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation, and that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. You know, it's just a occupational hazard is to look, oh, those high months are wrong. What about the low months? You know, we have a very low month potentially in November. You know, it's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month, I think it's 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil.
Thanks, Chair. Thank you, Chair Powell. Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course, that's part of what we do, but you know, we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of, just take the last year, we've seen inflation, well, over the last couple of years come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. You know, a lot of things move financial conditions around, as you know, and we don't really control those, but I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
So, you know, we're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Hey, happy holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's when in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. If you look around the world, there's just a lot of slow growth and continuous struggle with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was the you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about half a percent rather recently. The question, I guess, is do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so, no. I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation. And that's part of the reason that explains why we moved ahead today with the action, with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and we want to keep it that way.
Amira.
Thank you, Amara Mokoy from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way, in the strong position that you have described, without further cuts? In other words, do you still view the labor market as needing support to protect against a further cooling?
We can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates, and we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. Job creations are meaningfully positive. Wages are, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals, and we pay close attention to it, and it's worth noting that it is still gradually cooling, and in an orderly way, and that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
It breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to have had a deep recession and high unemployment by now. Well, that has not been the case. So, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that. And it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices, and that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there, so that people are earning big real wage increases, so that their wages are going up. Their compensation is going up faster than inflation year upon year upon year, and that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration? I feel
very good about where the economy is. Honestly, I'm very optimistic about the economy, and we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Thanks, Chair Powell, for doing the questions.
Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What percent do you see and the committee believes, where is that neutral rate?
So I'll say a couple things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance and we're looking at the way it's hitting the economy. And particularly, we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be, there are things that affect the economy that are lasting but not permanent. And the ones that are permanent are the ones that would be in our star. The ones that could be lasting but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it. And I think we're in a good place, but I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to the empirical data that are coming in and also how it's affecting the outlook. And it's not made any easier by the fact that that our policy works with long and variable lags. Nonetheless, that is the job we have, and so I think it's appropriate for us now to proceed cautiously, now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market, while we can still make progress on inflation because policy is still meaningfully restrictive.
Victoria. Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation, even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering, what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation because that's what people experience. People don't experience core inflation, they experience inflation, and that includes food and energy costs. So that's the overall goal. But, as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be because it's a better measure of what inflation pressures exist. So it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down but headline potentially ticking up?
So headline can be affected, you're talking about next year.
Mm-hmm.
Yeah, so headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. So that's why the two can go in different directions. I mean, headline has been lower, as you know, most of this year, but that's because energy prices have been coming down, which is a great thing for people, but energy prices will come down and they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy
So
prices?
we monitor geopolitical risks really quickly, but really carefully rather. But I would say so far those risks haven't really. Nothing has come out of those risks that has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of supply conditions, global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, so inflation, again, we don't overreact to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation, and it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now, and we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow-up. Let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, it's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now, and we're kind of projecting that the same kinds of things are happening. So we keep a strong labor market, housing services inflation comes down, goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time, and those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong though that it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track, and I think if 2 years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, "I'll take that." I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways. Appears to be settling in around 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That is, and I am confident we will achieve that. It has taken longer, but it's you have to be, we are making progress. We have made a great deal of progress, and we'll continue to do so and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world. That doesn't appear to be a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much.
Powell says the central bank is significantly closer to the neutral rate, and that if the job market remains solid but progress on inflation continues to be slow, then the Fed would have reason to continue with a cautious approach. Powell says there are 4 reasons why the Fed has changed its path forward for next year. 1, the economy is stronger than expected. 2, the unemployment rate is lower. 3, inflation is higher than forecast. And 4, the committee is closer to that neutral rate. To cut rates further from here, Powell says that the central bank will need to see further progress on inflation. He underscored that inflation, measured by a 12-month basis, has been moving sideways this fall. The Fed appears to see greater risk to inflation relative to the labor side of its mandate, sort of a flip-flop from what we saw from the chairman late summer, early fall. Of course, risks are still balanced as a whole, but the Fed clearly seems to be paying more attention to inflation at this point. Now, Powell also made clear that some members of the Federal Reserve are taking into account policy uncertainty that could come from the next administration under President-elect Donald Trump and how that could factor into setting interest rates. Lastly, Powell said today's decision was a close call, but that he personally supported the rate cut. Every year we see members of the regional bank, 4 members of the regional Federal Reserve banks rotate, and next year we will see Goolsbee from Chicago, Collins from Boston, Musalem from St. Louis, and Schmid from Kansas City. If you looked at today's action and what happened, we saw a dissent from Beth Hammack, but there were also 3 other members, so 4 in total, who would have liked to have seen interest rates kept at current levels. So we can sit here and speculate perhaps if some of next year's voters may be included in today's group, because we know that Musalem and Schmid are markedly more hawkish. Collins seems to go with the pack, Goolsbee a bit more dovish, but overall perhaps we could see a slightly more hawkish Fed next year, just as we're already seeing rate cuts slimmed back to only 2 cuts for next year.
Guy Labat, Jenny Montgomery Scott, head of fixed income, along with Luke Tilley, Wilmington Trust chief economist and former Philadelphia Fed economic advisor. Luke, I'm going to start with you here because you are still expecting a pretty steady trajectory of cuts next year. Is the dot plot changing your outlook on that front?
No, I don't think so. I think that the members of the FOMC are rightly a little bit cautious about inflation given the numbers that we've gotten, but I think they're a little bit too sanguine about the labor market. The labor market has slowed significantly. If you look through all of these storms, private non-farm payroll growth is now just 108,000 on average over the past 6 months. And you also have labor demand falling precipitously. So I think that the labor market is going to end up having them cut faster than even they are saying today. And we're expecting those rate cuts to come through until September of next year, at every meeting until next year. And we'll be at neutral before we get to the end of 2025, Julie.
Guy, I want to bring you in here as well, get your quick response to the news, Guy. What the Fed did here is what you expected, Guy. Was it the right moves, in your opinion?
Well, I do my best not to judge whether the Fed is doing the right thing, because that makes more likely they're going to miss whether we think they're doing what they're going to do. Poorly phrased, but you get the point. I think the sort of underlying story, and this is a little bit buried within the SEP, the economic forecasts, is if you take a look at the Fed's inflation expectations for 2025, the median of those expectations bumped up considerably, but the range actually shifted somewhat higher as well. So the central tendency expectation for core PCE inflation for 25 is now between 2.5% and 2.7%. And look, if that forecast comes to pass, which it's very, very hard to judge the inflation outlook 6 or 12 months hence, if that forecast comes to pass, I think 2 cuts is more likely to emerge than 3 or 4 or even more than that in 25.
And Guy, what effect does that then have on the bond market, right? Which is your bread and butter here, looking at what happens in fixed income. How is that going to affect? Because what are we seeing currently priced into fixed income?
Yeah, right now, or at least heading into the meeting this morning, there was round numbers about 3 cuts priced in 2025. And frankly, I don't think, and I want to separate put some distance between what I anticipate is likely to happen and what the markets are going to price. Because Luke's point a minute ago, the markets are going to continue to price some downside risk of economic slowdown. I'm just not convinced it emerges. So the markets are probably going to leave that pricing somewhere in that 3-ish cut range for 2025, even after this announcement. And I don't think Powell is going to guide terribly different from that at his 2:30 press conference.
Luke, back to you. I'm just curious. They cut as expected. Luke, I'm wondering, what are the risks of doing a cut, in your opinion?
I don't think there's any risks of doing a cut right now. I think there's a risk that they're saying that they're not going to cut rates even more. So I understand that the inflation data has stalled out a little bit, but if you just separate the shelter component and look at all other components of inflation, the Fed has already been at target for about 18 months, whether you're looking at PCE or CPI. It's really just that shelter component that is keeping things high, and we know the lags from market rents. So right now, consumers are not really in any kind of position to keep inflation accelerating. And with the labor market worsening, I think that that they need to end up revising downwards here and be cutting more because the risk is that they are too tight for too long. Real yields are still very high compared to the past 10 or 12 years, and it's putting a pretty solid brake on the economy right now, and that's the real risk, Josh.
Luke, it's really interesting because I think fair to say the consensus is not where you are right now, right? And it seems like the crowd has sort of looked at the past couple of years and said, we kept underestimating growth. We're not going to make that mistake again. Do you think that is the wrong lesson to take away right now? They're sort of fighting the last war, if you will?
Yeah, I do think it is the wrong lesson because the real lesson to take is even when growth is strong, inflation has been coming down. That was the real mistake of 2023, is not realizing that inflation could come down. That's coming from companies getting more productive, from people joining the labor force. And I expect that now we're going to have the economy slowing down and inflation will keep coming down. And that's why I think the Fed will end up cutting a lot more than they're saying today.
Guy, what did you make of the argument? I did hear some making this, which they should have paused here, Guy, because the fiscal policy outlook is so uncertain with Trump moving back into the White House, taxes, regulation, tariffs, immigration, so unclear right now, Guy. That's why they should have held off. What's your response to that line of thinking?
Yeah, I mean, to borrow a phrase from Lael Brainerd, when in a dark room, move slowly. You don't want to bark your shit on the coffee table, which I guess the coffee table is an economic slowdown in this case. But the point being that with an uncertain outlook, the natural tendency is to move the trajectory of interest rate changes a little bit more gradually. And I don't see a lot of downside to that right now. Now, Luke, I know you made the argument that labor activity is slowing considerably. It doesn't strike me as an immediate problem, certainly not one that's going to be resolved with aggressive downside action in the interest rate markets, not in the very short term. I suspect really what we're going to see is just in response to the potential fiscal changes in 2025, most of which will hit in late 25. In response to those changes, the Fed's just going to act more gradually rather than more aggressively. And today is sort of the last, in my expectation, of the consistent 25s at every meeting. And we'll probably slow down in early 25 to perhaps 1.25, perhaps just 2 for the full year. And that's that gradualism that I mentioned a moment ago.
I think this was generally as expected. The markets were fully priced for a 25 basis point rate cut. But the dots did move around and the Fed's projections moved around, and they moved around in a way that was, hawkish on the margin. So, some folks have been calling this the potential for a hawkish cut. I think that's basically what we have with the updated projection materials. And we anticipated that the Fed was likely going to really slow things down after this rate cut. And that's just based on the criteria that Fed Chair Powell laid out for the rate cuts that have happened to date and what he has said recently. And, we can go through those details, but his most recent comments were that the economy was outperforming what the Fed expected when they started cutting rates in September. That's really all we needed to hear to assume that they were probably going to go on a multi-month pause after this move today.
Michael, I don't know if you just heard the conversation we were having with Luke Tilley and Guy Labat, but Luke seems to think that the labor market is indeed slowing and that their risks, the economic risks, are more to the downside right now. What do you think of that view and the view that the Fed doesn't seem to feel that way?
I have a lot of sympathy for that view, as you know. The economy has held up better than I thought that it would. I mean, we have avoided any kind of a obvious or technical recession so far, which is pretty remarkable considering the previous Fed rate hikes and the 13-month pause at peak policy rates and all of the other signals that we were getting that you tend to get before you go into a downturn. What's really strange about the current backdrop is, and I did hear that conversation, really good one, no doubt the labor market is cooling. So I'll even give you a different statistic. The previous guest mentioned private sector payrolls, but if you take healthcare jobs out too, so government and healthcare, non-cyclical sectors, private employment growth is running at about 55K over the last 6 months. That is half the level that we were seeing pre-pandemic, with an economy, at full employment and inflation at or somewhat below the Fed's target. And these growth rates have come way down. If you look where the 6-month growth rates were, say 6 or 9 or 12 months ago, this is a pretty significant and material cooling in the labor market. The unemployment rate now has leveled off for the last few months, but was starting to hook upward in a way that you only see at the beginnings of recessions this past summer. And I think that's one important factor in the Fed starting out of the gate with that 50 basis point cut in September, because it looked like maybe they were falling behind the curve and you had the labor market really cooling sharply. So now it's a little bit more of a mixed bag. The unemployment rate is leveled out for the time being. It does look like the underlying pace of job growth is slowing, but some of the other data has been a bit better. GDP tracking estimates for the fourth quarter are up in the 3s. So, people look at that and they look at the stock market today, excluded, and they kind of scratch their head thinking, what is the sense of urgency here? Why is the Fed doing 100 basis points of rate cuts when everything seems to be fine? But I do think the underlying steam in the labor market is easing up. And the risk here is that the Fed pauses. We end up with those supply side tailwinds potentially turning into headwinds, and then they find themselves behind the curve, and cycle risk starts to rise again. I mean, that is a significant risk for 2025 in our estimation, and you have incredibly high equity valuation, so a lot of smooth sailing and good news have been priced in.
I think it's unlikely we'll get a rate hike next year, but I do think it's likely. And this is, I think, the first time we're starting to hear about it, that people are going to increasingly talk about it. First we have to price out any further rate cuts before we start to talk about a hike. But on the way there, and this started kind of in September, when we had a lot more rate cuts priced in compared to what we have now, and now we only have less than 2 rate cuts priced in. We're starting to think about that, where this could go. Again, markets tend to extrapolate. What could change this? Real simple. If you continue to see the unemployment rate slowly go higher as it's been doing for a year, that could put a lid on yields and I think would be bullish for equities.
So this is really interesting, Michael, because the narrative for so long was, as long as the economy is sort of plugging along here, even in the interest rate increasing regime, when it was that stocks could do okay, right? And we heard Jay Powell, he talked about a lot of uncertainty, but one of the things he did not seem to be uncertain about was the solidity of the U.S. economy. So I guess I'm trying to think, but you're saying if things get a little bit worse and rates come down, that could be good for stocks. I guess I'm just trying to sort of process all of this.
Yeah, it goes back to kind of thinking about what the primary issue is for equities. So almost a little more than a year ago, we held on to a bearish call too long with many others in the recession camp, but then changed our view in October of 2023 because it was clearly evident that higher interest rates were the problem for equities when we saw that last, I think it was a 12% correction in stocks. So our message back then was that anything that brings down interest rates and gets the Fed to pivot will be bullish for equities, including higher unemployment. So we're kind of still there in terms of that view. The relationship between interest rates and equities has ebbed and flowed in recent months, but clearly we're back to a pretty negative correlation. So again, the problem of, when you listen to investors, people are not worried about the economy falling off a cliff, but they are worried about higher inflation. And I think 2022's experience created a paradigm shift in investor sentiment, where if I think about most of my career from early 2000s through 2021, pretty much every market sell-off was a function of a growth scare. And think about the recessions or periods during ZIRP. Whereas in the last couple of years, really markets have only gone down because of rising interest rate or inflation fears. And I think that's the new normal, that going forward, market corrections are going to come from higher rates, not slower growth or higher unemployment. And when you look back far enough throughout history, that's actually the more common reason equities go down compared to the last 20 years.
The Fed gives you the cut, right, that was priced in. They also, though, signal fewer cuts are coming that was previously expected. This reaction, Tim, stocks plunging, yields surging, make sense of it for us.
Well, Josh, I think it's really what investors need to be paying attention to all next year, which is there is such high expectations across the board, right? The expectation for the Fed that they're going to continue on this aggressive pace of cutting without any economic pain. It's great if it plays out, but today, as you see those expectations pulled back, you see the market pull back. And it's more extreme because we've seen so much good news priced in. When we look at the market trading at 22 times next year's earnings, there's a lot of good news that has gone into that. And any piece of information, like the Fed today, that goes against that narrative, it's going to hit valuations, which in turn is going to take a big hit to stocks.
But if the economy is as strong as Powell is saying, and that's why they're not cutting, then what's the problem?
I think the big fear is a reacceleration in inflation. I don't understand why the Fed cut today. I really don't. I mean, you have an economy in good shape.
But that fear is at this point based on what? Because it's not necessarily in the numbers yet.
I think it is. If you look at core CPI is exactly where it is today, where it was back in June.
But that's not a reacceleration. That's
sticky,
just a stalling.
But I think they're getting nervous about the new administration coming in. You look at different policies.
So you think it could be fiscal policy?
I do think the pro-growth policies coming out of Washington. There's fear of that. The tariff piece of the equation, the immigration piece. You start deporting mass immigration, deportation of immigrants. What that does to the labor market, it's got to put pressure on wages, which in turn, puts pressure on inflation. So I think that is something investors need to be very focused on next year and not just become complacent. And we're seeing that stickiness in my view right now.
Did what the Fed did and said today, Tim, did that change at all how you want to be positioned in the market?
I think it doesn't change our stance, and our stance really over the last couple of years is investors need to be very cautious on their expectations for the Fed. We've seen them really be completely wrong over the last 2 years, underestimating how quick and how many hikes were going to be coming, and now just overestimating how quickly and how many cuts are going to be coming. And really, we think right now what is incredibly important is anything in your portfolio, you have to disconnect risk management from the need for interest rates coming down. We see interest rates and inflation as the number one threat to equities. What can rain on this party? We think higher interest rates can. So investors need to really disconnect the need for risk management and interest rates in their portfolio in 2025.
Where do you think that inflation is going to come from if it does reaccelerate?
I think probably following the same playbook that you saw to kick things off. Goods maybe they're starting to reaccelerate, services as well. You don't know, but again, inflation is a pretty simple equation at the end of the day. It's supply and demand. The more people that are chasing the same goods and services, the more those are going to be going higher. So specifically when we look at the labor market, again, we see it as very strong. You start taking supply out with the immigration piece of the equation. You add the tariff piece back in. What does that do? I think it's hard to make a case that you're going to see inflation just drop back down to 2%.
Well, Tim, you look now, so the election's behind us. Last Fed decision of the year is behind us. As you look forward, what's the next potential catalyst for the market?
Well, I think, one of our themes for 2025 that we've seen is this animal spirits just awakening and driving markets higher. It's really been an optimism-driven market. You look at the gains in the S&P 500 this year, about 60% of those gains have been driven by valuations simply expanding. We think that optimism can potentially continue, right? So that could continue to drive markets higher. But I think on the downside, what could really, like we saw today, what could stop the party is a lot of this good news hinting that it's not going to come through. And I think the next piece of this, Josh, really could be on the fiscal side of things. A lot of the proposals that the Trump administration has put out there, mainly tax cuts, you start to see those not going through or starting to get held up in Congress. That's another reaction that I wouldn't anticipate seeing something similar to what we saw today.
Well, and even with the fiscal policy, even before Trump gets into office, right now we are watching questions about whether the government is going to shut down or not on Friday. It looked like the Congress had a bill in place. Now there's some reporting out there that Trump might be against that. Elon Musk has made noises about being against that. How concerned? I mean, maybe that just gives us a little hint.
Well, I think that's something that is incredibly important. You start to see some disconnect here, right, where you aren't able to get these funding bills through. That is probably the biggest risk to the markets.
In the
right?
short term.
In the short term and in the long term, too. You stop getting those deals funded, that creates very big issues. So certainly something we want to be paying attention to. And that puts, that question of, when is all of a sudden the national debt going to become an issue? That puts that right back into play.
I'm looking at just on the screen. I mean, there's lots of red everywhere, Tim. The small caps, though, really took it on the chin. Russell 2000, that dropped more than 4%. How do you think about small caps from here?
Well, I think we think there's going to be a tug of war really all year long for small caps to see if they're going to go up or they're going to go down. And one of the things we've seen really all year is you've had these head fakes, right? Peak CPI, you had a run up. Fed starts cutting, you had a run up. They pause, you have a run up. And all of those have fizzled out. We think you're going to continue to see that back and forth. But some of the things that give us a little bit of optimism here is you're starting to see PMIs tick up, which is important. That they tend to follow in lockstep with PMIs, and then you're also seeing small business optimism increase. And I think you look at the beneficiaries of the Trump's proposal of reduced regulation. Small caps are front and center in that. But that doesn't mean there's not going to be some bumps along the way. And I think today, with the interest rate piece, you saw a big speed bump. Small caps, I didn't see where they finished down, but it was a pretty big move.
Yeah.
Significant move down. So it's not going to be a pretty ride. I think there's going to be a heck of a lot of volatility within the small cap space, but ultimately we're cautiously optimistic.
For more, we're bringing in Yahoo Finance senior reporter Alexandra Canal. Allie.
Hi, Josh. Yes, a summary of economic projections. It's only released once every quarter, which is why investors, they're so keen on seeing what central bank leaders are thinking when it comes to different economic indicators like inflation, the unemployment rate, GDP, and yes, of course, interest rates. So let's start there. Each dot represents a specific FOMC member. And as you can see, over the long term, interest rates are expected to tick lower. However, you see that there's a lot of dispersion since the further we go into the future, the more difficult it is to predict what exactly will happen. But if we zoom in on 2025 alone, we'll see that most FOMC members, they expect 2 interest rate cuts so that the interest rate, the Fed's funds rate, will come down to 3.9%. We see 5 officials seeing more than 50 basis points worth of cuts next year. And then we have this one lone guy up here who thinks that interest rates are going to remain steady, remain where they currently are. Now, if we compare that to the previous September projection, a lot less easing is expected. So back in September, most FOMC members thought we were going to be seeing 4 interest rate cuts in 2025. Obviously, that's up from the 2 that we now expect to come next year. Now, one of the main reasons for that is sticky inflation. We've seen core inflation be incredibly elevated due to sticky costs of shelter, along with core services as well. The Fed projecting that core PCE inflation, it's going to tick up to 2.5% in 2025. That's higher than the September projection of 2.2%. We will eventually reach 2% in 2027, but again, that's a few years down the line. Jerome Powell, during the presser, he said that inflation remains the biggest factor, the biggest hurdle for the Fed to overcome, and it's an important part of its dual mandate, so something that they'll be keeping a very close eye on. The other part of the dual mandate is the unemployment rate. Now, that's expected to tick slightly higher to 4.3%. That's a little less from September, and then we are expected to remain at that level over the next few years. Longer run, though, 4.2% is what the Fed is projecting. And then finally, GDP, that's been incredibly strong this year. It is supposed to have a deceleration in 2025 to 2.1%. We will eventually hit 1.9% in 2027. But again, Jerome Powell in that presser was saying that the economy has remained incredibly resilient. Of course, there are a lot of risks next year with the incoming Trump administration, but all things that the central bank said that they can handle.
Fed Chair Powell, not only providing insights into the central bank's rate cut decision today, but also pointing to the Fed's thinking, Ben, about life under a new Trump administration. Any takeaways from Powell's comments today?
There was one moment in particular that I'm writing about for Yahoo Finance this afternoon that I thought was pretty emblematic. He was asked about the 2018 Teal book study of tariffs. So it was a tariff from about 6 years ago on tariffs. Not only did Powell know exactly what was in it, he had it with him, he indicated. So he had this study with him, which was a study under Trump 1.0 about tariffs, the effects of them, whether it's possible to, quote, look through tariffs. So it's basically what the impact on monetary policy could be from tariffs. He's clearly top of mind for him, and it's sort of emblematic of him trying to thread this needle of, as you guys have been talking about all day, make monetary policy based on what he knows now, but kind of be ready for Trump policies once he knows more about what they are. He talked also in the press conference about he's looking at tariffs. His colleagues are looking at tariffs, but they don't know what the tariffs are going to be, exactly how their effects are going to be. So they kind of have to be ready, but not changing policy yet. But clearly having that printout with him today shows that he's getting ready.